Are you ready to unlock growth, build resilience, and confidently take the next step in leadership, career, and faith? Welcome to The Next Move. I'm Orvin Kimbrough, a CEO, author, and leader with a passion for helping people and organizations thrive. My journey from foster care to CEO has fueled my mission to help professionals scale their confidence, leadership, and influence through mindset shifts, expanded networks, and bold action. Each week, I'll share reflections ripped straight from my blog to inspire and empower you with actionable insights. Let's get started and make your next move your best move. Welcome back to The Next Move, the podcast where we explore faith, leadership, and personal growth to help you take your next step with purpose and confidence. Today, we're diving into the misunderstood lifeline, why banks borrow and why it matters to Main Street. When I entered the banking industry, I didn't come from finance. I was an accidental banker, someone who built a career in community leadership, not financial services. That outsider perspective allowed me to ask questions seasoned bankers often take for granted. And let me tell you, some of those questions have led to eye-opening realizations. There are 3 core risks that are foundational to managing your local community bank: credit risk, interest rate risk, and liquidity risk. Each one is key to keeping our banks running smoothly, making sure that they serve customers, they stay stable, and can handle the ups and downs of the economy. But here's where things get interesting. One of the biggest misconceptions in banking is about liquidity, specifically how banks manage cash flow to ensure stability. There's a financial tool that helps with this. It's called the discount window at the Federal Reserve. But here's the kicker. It's often misunderstood. Even by those inside the industry, banks hesitate to use it, fearing it might signal weakness. But is that hesitation helping or hurting? Let's break it down. Today, we're unpacking why this matters. Not just to banks, but to businesses. Why it matters to communities and the everyday people who depend on access to credit. If you've ever wondered how banking decisions impact the economy around you, this episode is for you. Let's dive in. When I first stepped into banking, I wasn't a banker. I was an outsider, a leader shaped by community work, not financial markets. That meant I often questioned things that industry veterans saw as common knowledge. Even now, 7 years into my banking journey as CEO of the second largest privately held bank in my state, in my city, St. Louis, my state, Missouri, those questions continue to spark deeper realizations. Take liquidity management, for example. Banks need cash on hand to meet withdrawals, just like businesses need working capital. The discount window, a tool that allows banks to borrow from the Federal Reserve, exists for this reason. Now, it's one of several ways in which banks can borrow money, but the discount window ensures financial stability, yet it carries an outdated stigma. So when I look back at history, I'm wondering, where did the stigma come from? This perception of borrowing as a sign of weakness didn't come from nowhere. Decades ago, before banking regulations strengthened, banks that relied too heavily on the discount window were often struggling. Some even collapsed despite access to emergency liquidity, reinforcing the idea that borrowing from the Fed meant you were already in trouble. But today, our financial system is structured differently. Regulations require banks to maintain higher capital reserves, financial transactions move faster than ever, and market dynamics have changed. In other words, the old reasons for avoiding the discount window don't fully apply anymore. Yet the stigma persists. A year ago, I sat in a room full of seasoned bankers debating the discount window. Regulators encourage its use, yet many banks resist, fearing it signals distress. But here's the thing. Our financial system moves faster than ever, and access to liquidity isn't just a banking issue. It's a Main Street issue. So, what's the discount window? At its core, the discount window is a short-term lending mechanism for banks. Think of it like a business line of credit. Banks pledge high-quality assets like government bonds to secure these loans, ensuring they can meet withdrawal demands, particularly in times of stress. In short, it exists so that your money is there when you need it. Yet despite its purpose, the discount window remains underused. But why? Why the stigma? There are at least 4 reasons, if not more. Today, I'll talk about 4 reasons. There is a perception of weakness. Borrowers from the discount window is often viewed as a red flag, suggesting a bank is struggling. But liquidity challenges are common in all businesses. So why should banks be judged differently from borrowing from the discount window? The second really comes down to public disclosure and reputation. The Fed discloses which banks use the discount window. I think it's after 2 years. While meant for transparency, this can unfairly damage a bank's reputation, especially for publicly traded institutions. But let's be real. Does the average depositor even track this information? I would say probably not. The third issue is regulatory contradictions. Regulators say banks should use the discount window, yet some examiners still view reliance on it as poor liquidity management. This contradiction creates hesitation. And the final point in terms of why the stigma is the competitive pressures. Banks worry that using external funding, even a prudent and legitimate source, could erode customer and investor confidence. So because I focus so much on Main Street, I'm asking myself the question as I look at bank liquidity, why should Main Street care? At one point in that banker discussion I mentioned earlier, I asked, who exactly is the negative interpreter? Do everyday depositors care where a bank borrows money from? Do they even track it? The answer is probably not. But in banking, perception drives decision making. And that perception affects whether capital keeps flowing or drives up when it's needed most. The collapse of Silicon Valley and Signature Bank showed how quickly liquidity crisis can unfold in today's digital age. When banks hesitate to use the discount window and other tools due to outdated stigma, they often take riskier actions, selling off assets at a loss, restricting lending, or tightening credit access, all to avoid the optics of borrowing. And that hesitation, well, it hits Main Street directly. Think about it. If small business owners or families were shamed for using credit lines to manage cash flow, the economy would be in chaos. Yet that's exactly what happens to banks. The tools exist, but old biases keep them from being used responsibly. And when banks hesitate to shore up liquidity, the ripple effects are real. Here are three of the ripple effects. Lending tightens. Small businesses will struggle to secure loans. Borrowing costs rise. Banks charge higher interest rates to maintain liquidity. Community investment declines. Less money will circulate locally, affecting home ownership, affecting job creation, and affecting economic stability. So we've got to reframe how we think about this. The financial system depends on trust and resilience. Using the discount window and other liquidity tools isn't a sign of distress. It's smart liquidity management. After all, businesses and households use credit responsibly all the time. Shouldn't banks be able to do the same without stigma? If the tools designed to stabilize the financial system are stigmatized, we must ask, are we prioritizing perception over economic resilience? And if so, who really pays the price? This isn't just a conversation for bankers and regulators, it's for all of us. When a financial crisis hits, a lack of understanding leaves businesses and communities and policymakers scrambling. The time to educate isn't in the middle of a crisis. It's now. So here are three things that I want us to consider doing. Number one, as business owners and community leaders, ask your bank about liquidity management. Remember, this is one of the three core foundations of banking. It's one of the three core foundations of your local Main Street community. So ask your bank about liquidity management and how they protect depositors. Understanding these tools can help you advocate for financial policies that benefit your community. Number two, for our policymakers and regulators, consider how financial education can be improved and whether outdated narratives are unintentionally creating risk. And I'm not talking about at the top level, I'm talking about in the bowels of the organization. How do you train new examiners and shift their mental perspective? And number three, banking professionals. Let's challenge the internal dialogue. Let's normalize discussions about liquidity tools, including the discount window, and ensure that perceptions don't get in the way of sound financial decision making. Line your actions up with what the regulators have said we can do as bankers, and then hold them accountable for what they said. So let me bring this back to just basic financial literacy. Financial literacy isn't just about individuals learning to budget. That's foundational. It's about understanding the broader systems that shape our economy. If we normalize discussions about things like how liquidity works, we make banking more transparent and less intimidating. If we educate communities on how banks manage cash flow, we reduce the fear and misinformation that can trigger bank runs. And if we treat liquidity tools as a normal part of financial management, just like lines of credit for businesses and homeowners, we create a more stable financial environment for everyone. We don't wait for hurricanes to teach storm preparedness. We shouldn't wait for a banking crisis to educate people on financial stability and liquidity management. The time to start is now. Until next time. Thank you for tuning in to The Next Move. I hope today's reflection inspired you to take the next step in your leadership career or faith journey. If this episode resonated with you, share it with someone who might need a little encouragement this week. Don't forget to subscribe so you never miss an episode. And if you'd like more reflections or resources, visit orvinkimbrough.com or theaccidentalbanker.com. Until next time, remember, every step you take brings you closer to thriving. Let's keep moving forward together.